So now we will learn about the option contracts and risk management using options. So as you understood that there are four types of derivatives: forward, swap, future and options. So forward and swap are traded over the counter, and future and options are traded over the exchange. And we will talk about exchange traded option contracts. So if you recall from our previous classes, so derivative is a type of a contract so which derives its value from price of an underlying asset. So if the price of underlying asset changes, the price of the contract will change. So till now we have understood that in future contracts, if the spot price goes high, the contract price goes up. If spot price goes down, the share price goes down. So assets can be stocks, commodity, currency, anything. And we know that the option, if we talk about options, then options and again type of derivatives, or option is a type of a derivative or a contract where buyer of the option contracts. So remember one thing, buyer of the option contract, not seller of the option contract. So any contract can be bought and sold. So option contracts can be bought and sold too. So where the buyer of option contract has the right to buy or the right to sell. If it is a put option, right to sell. If it's a call option, right to buy. But no obligation to buy or sell. So let's understand this thing in detail. So there are two types of broadly option contracts. We have call options. So that means call option contract which we can buy and which we can sell. And then we have put options which we can buy and which we can sell. Okay. So if we say about buyer of the call option has the right to buy stocks at strike price. So what do you mean by strike price? This is the agreed price between you and the seller. Okay, so this is the contract price. So in options, you can have your price set. Okay, and you may find the seller who is interested in selling at that price. So buyer and seller has, buyer of the contract has the right to buy stock at a agreed price or a strike price, but is not having the obligation to buy the asset. Okay, so if he wants to deny on the date of delivery or before that, he can deny. Okay, and the seller will have no right over that. So what happens is, for this thing, this right to buy but no obligation to buy, to get this facility, the buyer of the call option pays premium, something extra. It's not advance, this is extra, that is premium. Likewise, seller of the call option obligation take the obligation to sell at the stock price, strike price, if the buyer of the option contract comes to buy. Okay, so he must has to give, he cannot deny. He must have to give. Okay. Okay, so he must give, the seller of the contract must give the underlying asset delivered if the option contract buyer exercises the right to buy upon the seller. And for that, okay, he is taking that kind of obligation, okay, for that he is receiving premium. So seller has the obligation, he has no right. If the price goes up, the buyer will come to buy. Price goes down, the buyer will not come. The seller may face losses. And for that risk, the seller receives the premium. Okay? Now, then we have put options. In put options, the buyer of the put contract has the right to sell the stock. Okay, so right to sell the stock at the strike price, but no obligation to sell. So if he wants to sell, he will sell. If he doesn't want to sell, the seller of the put option has the obligation to buy. So the buyer, okay, cannot force the seller to deliver the good. If seller says, no, I don't want to sell because I have the right to sell, because I have bought the put option. So if I have the right to sell and no obligation to sell, you cannot force me to sell it. So the seller of the put option, which is basically the buyer of the underlying asset, has no right to take it. It can only buy when the seller of the option contract, buyer of the put contract or the seller of the stock comes and deliver the stock to seller of the put, seller of the put option, or broadly you can see the buyer of the underlying asset. And for that obligation that he will ready to buy any time if the seller comes to sell the asset. So the put option buyer is, whenever it comes to sell the asset, the buyer will be always ready to take it, and for that he receives premium. Now, this is a complete definition, but it will be hard for you to understand. So stay here. I'll give you an example. Let's recall what happens when you buy future. So let's say this is you and you want to buy a house. What you do? You look for a buyer. Okay? So what you do is you look for a buyer. And buyer says that yes, I'm interested in selling the house for, let's say, $1 million. The buyer says, okay, fine, I'm ready, but I want delivery after 1 year. And I can book it by paying, let's say, 100,000 as advance or initial margin. Then the seller says, if you want to take it today, take it for 1 million, but if you want to take delivery after 1 year, you have to pay me 1.1 million, because I will lose some interest over that if I deposit that money into a bank. So it's an opportunity loss. Okay. After 1 year, what happens? Let's say the spot price in the market goes to 1.2 million on 31st December, let's say after 1 year. And then the seller comes and says, give me 1 million and take your house. So you have already paid 0.1 million, that is 10% as advance, that is 100,000 as advance. So remaining you pay 1 million, okay, because you had a deal at 1.1. So you pay remaining 1 million and take the house. And what is the current market price into the market? That is 1.2 million. So you are making a profit of $100,000. So that's pretty impressive. Okay, if rate goes up. So deal was at 1.1 and market price went to 1.2, so you're making profit here. What if condition 2? If the price goes to condition 2. So what happens is that if price goes to 900,000 on 31st December, instead of 1.2 million, it is, it went lower. From 1 million, it reduced to 900,000. In that situation, what is happening? Now, is incurring loss of 200,000. Why? Because seller is asking remaining for 1 million. You have paid already 100,000. So remaining 1 million, the seller will ask. The buyer says, no, I cannot buy. I'll face losses because market price is much cheaper now. Then the buyer says, we have a contract. If you deny, I'll drag you to court. And in the court, you have to pay because we have an agreement. So in future contract, if it is profitable, you have to execute, get the profit. If you have losses, you have to execute and bear the losses. So you have unlimited profit, unlimited loss. You cannot deny. You have to face the losses and you have to take the profit. Okay. But so let's say this is the payoff chart for future and contract. So we have unlimited profit and unlimited loss. So how to read this? This is horizontal line. We have profit above zero and below zero we have losses. And this is the price line. So let's suppose you have had a deal at 1.1 million. I have written crore here, sorry. So it is 1.1, let's say crore, and the price goes to 1.2 crore, you make profit. You make profit of how much? 0.1. So this is what is you making. And if price increases more, 1.3, you make more profit. Price goes up, you make more profit. Price goes higher, much higher, you make more profit. Likewise, if price goes down, you incur losses. So incur loss of, let's say, minus zero point 0.2 crores. So this line basically is the slope of your profit and loss. And the remaining is the price line and the profit and loss line. Remember this payoff chart. This will be used again in options. Now, what happens when you buy a call option? Okay. So here, hold on for a second. Yeah, I'm back. So what happens when you decide to buy a call option? So let's suppose this is the house, you're planning to buy a house. Yeah, I'm back. So I was discussing, let's suppose what happens when you buy a call option. So this is a house. Let's say you're planning to buy a house. Same, you look for a seller. Seller says, I'm ready to sell my house at $1 million. You say, I want delivery after 1 year and I can book it by paying $100,000 as an advance money. Then he says the future price will be 1.1 million if you want to take delivery after a year. Then he says, I have one more condition. What? That I don't want any obligation to buy. Why? There could be situations. Let's say I want delivery after 1 year and I was planning that my kids will come from US to India and then they will stay with me. So if they come, then I'll buy the house. If they don't come, then I don't want to take the obligation. I'll deny because then I have no use of a bigger house. It could be anything. Or you may think like this, the future prices will rise. So if the prices will rise, I'm doing a contract at 1.1 million. If price goes to 1.5, I'll take the delivery. So I'll take the delivery at what price? I did contract at 1.1, so I'll take the delivery at 1.1 million. I'll sell it into the market for 1.5. I make profit. And let's suppose the price does not go up. It goes to 500,000. It goes to $900,000. I'll deny. I'll say no, I don't want to buy. So I'm being smart. If price goes down, I will not take it, and if price goes up, I'll take it. So if price goes down, I will not take it. If price goes up, I will take it as a buyer of the option contract. So as a buyer of which option contract? The call option contract. So call option contract has the right to buy but no obligation to buy. Okay. So I think like that, and then I say, okay, I don't want any obligation to buy. Then in that case, the seller says, what will be my motivation to sell you? Why should I sell you? Why do I do that? And whenever you want to buy, you buy. You don't want to buy, you don't buy. So what is my motivation? So seller being a little smart, he said then instead of paying initial margin, what you do is you pay me that $100,000 as a premium amount, which will be non-refundable in case if you don't come after 1 year to buy the asset. Isn't it? So it's a little smart thing to do. So if the seller doesn't come, price goes down, that $100,000 will be, kept by the taken, the seller. So this is the motivation of seller. So that's why seller will do the contract, because he's getting something extra if the buyer doesn't comes to buy the property. In that situation, the total cost to buyer will be 1.1 million is the increased price for 1 year already, and then 0.1 million is the extra premium charged over that. So his cost, the buyer's cost, would be 1.2 million. So what is the deal price here right now? Strike price, that is 1.1 million. The rate is 1.1. Premium the seller has taken, that is extra, that is 0.1 million. So total cost to the buyer is 1.2 million. Okay, so total price. Okay, so the cost extra beared by him is the premium, right? Now what happens after 1 year? After 1 year, let's suppose the price goes to 1.2 million. Then the buyer thinks that I have no profit, no loss. Okay, so I have no profit, no loss. So I can, take the contract, and he will give the remaining 1.1 million to the seller. So I have paid the premium amount, that was $100,000, okay, to the seller. But I had a deal. The price of the house, okay, the strike price was 1.1 million. So my total would be 1.1 plus 0.1, that is 1.2. So 1.1 is my strike price. Okay, so I'll come back and I'll show you. This 1.1 is the price for the house. So this is the strike price, agreed price for the house. And the premium is extra. So total cost is 1.2. So he has having no profit, no losses. Okay. If the actual price on the market on 31st December goes to 1.2 million. Okay. Now, condition 2. What happens after 1 year if the spot price goes to 1 million? Now, the price has gone down. The seller says, give me remaining 1.1 million. The buyer says, my total cost will be 1.2 million if I buy. Why? I have paid 0.1 in the beginning and I have to pay 1.1 right now. So my total cost will be 1.2 if I buy. And my total losses will become $200,000 or 0.2 million losses I have to face if I execute the option contract and take the house and pay the amount, because the market price is 1 million. So I'll have a loss of 0.2 million. Now, what if I don't buy? My losses will be limited to the premium amount I paid, because if I don't appear to buy, I deny, the seller can keep only the premium amount I have given. So the maximum profit to a seller is the premium amount he receives. Okay, that's so simple. See, buyer comes to buy, he will buy at the strike price, total cost will be his, price, and whatever is the market price, the difference will be his profit. And price goes down, he will deny. If he denies, the maximum loss for a buyer is the premium amount he paid. And for seller, the maximum profit will be premium received. Because if the price goes up, seller has to sell at a lower price. So it's losses. And price goes down, the seller will only receive maximum, that is the premium amount. So for seller, it is limited profit, unlimited loss in a call option selling. So when he's selling a call option or writing a call option, he is having limited profit up to premium and unlimited loss. But if we talk about call buyer, remember the buyer of the call option, this Superman, the buyer of the call option, he has the right to buy, no obligation to buy. He has unlimited profit if price goes up. And if price goes down, he will deny. If he denies, he has limited loss. Okay. So he runs away if price goes down. The maximum loss is the premium he paid. So here we can say the buyer of the call option has limited loss and unlimited profit. How? If the price goes to 1.2 million, 1.3 million, 1.4 million, he will take the house and sell in the market and make the money. Okay. Or he can do the cash settlement. And if price falls below the break-even point, sorry, below the strike price, the strike price was 1.0. If it falls below the strike price, he will not exercise the option contract. In that situation, he has given you 0.1 million. Okay, that will be his loss, as the break-even is 1.2. So below 1.0, he will not execute it. Price goes to 0.9, 0.8, 0.7, anything. He will not execute. So his losses will be limited to the amount of premium he paid. Okay, so it's fantastic. Hold on. So likewise, if we see about the seller of the option contract, if price goes up, okay, 1.3, 1.4, the buyer will come to buy because it is his profit. And you have to give him because it's your obligation to deliver the house. So for that you are receiving the premium. So if the price increases, you have to sell it for a lower price, lower strike price at which you had agreed. So it is all your losses. And if price goes down, this is the price line, it goes to 0.9, 0.8, the buyer will not come. In that situation, your maximum what you will receive is the premium, that was 0.1 million you receive from the buyer. So you have limited profit and unlimited loss as a call seller or a writer. As simple as that. So this is a matrix to recall the things. So if we talk about call option, we'll discuss only call, not put right now. So call option buyer has the right to buy but no obligation to buy. And for that he pays premium. So he has limited loss because he can deny and unlimited profit when price goes up. So buyer of a call option basically is bullish. He thinks the price will go up. And seller of the call option is basically bearish. He thinks the price will go down. So he takes the obligation to test sell. So seller is of the option contract is basically into short position. Okay. So he thinks the price will go down. So what he does is he takes the obligation to sell, and for that he is receiving some extra premium. And he is having unlimited loss if price goes up and limited profit if price goes down. Okay. So this is what is with call option buyers and sellers. Now, let's understand how do we do it online. Okay, so how do we do trading online using options, right? So when we trade online, we cannot negotiate with the party over the phone. So the strike price is different. You can get contracts for different strike prices. Okay, so if you want to buy let's say house for 1 crore, you get the contract for 1 crore. If you want to buy zero point 0.8 crore, you can get the contract for 0.8. Likewise, if you want to buy costly than the market, even you are buying costlier than the market, let's say 1.5, 1.6, you can get the contract for that. So at every strike price, you have contracts available. Now let's take example. Let's suppose the spot price for, let's say, Nifty index or any share, commodity, anything is 5,000. Okay. So if you are planning to buy a, let's say, call option, okay, so you're planning to buy a call option at 5,000 strike price. So that means you want to buy the option contract for Nifty or any share or gold or silver, anything, same as the market price or the spot price today. So if the strike price is same as, you can say the exercise price is same as the spot price, we call it at the money, ATM, at the money contracts. Remember this thing. At the money contract is same when the strike price and the spot price are same or very close. In the money contracts are those when the exercise prices are less than the spot price. So these are in the money contract, ITM. So we can see here, if you are buying cheaper than the market price, so if the strike price is less than the spot price, okay, so that becomes an in the money contract. And if you're buying the strike price is greater than the spot price, then it is out of the money contract. So we call it, OTM, out of the money contract. Okay, so this is out of the money contract. So if the market price is 5,000, you're buying it 5,300, this is out of the money. Now why anybody will buy costly? Because if you are buying a costly contract priced more than the market, you have to pay a lesser premium, that is only 20 rupees. If you're buying at the money, it is 50 rupees, and we're buying in the money, that is 130 rupees. So as you go in the money, the premium increases, and as you go out of the money, the premium is lesser. Okay, so if you talk about the at the money contract break even, which is 500 strike price, is 5,000, and the premium you're paying is 50, so your break even point or the total cost will come to 5,050. So if the spot price goes above 5,050, then you start making money. If you talk about 4,900, so 4,900 is your price and 130 is premium you're paying extra, that means 5,030 is your break even. So if the spot price increases, so after 2 days, 5 days, 10 days, if price goes to 1,000, spot 5030, so after that you start making money. So remember, we took an example of Infosys where the share price was 1173 and the future price was 1175. So if the share price goes to 1180, the future price will also increase because that share is the underlying asset. So Nifty is underlying asset. So Nifty is going up, the option price, the premium will increase. Now, so why this thing is higher, the lower strike price, and why the higher strike price or out of the money contract for call option is cheaper? Okay, I'll tell you why. See, if you're buying something cheaper than the market, you understand one thing, that I'm buying cheaper than the market, this thing at 4,900. So it has some intrinsic value. So intrinsic value, I can in simple words say that intrinsic value is basically the spot price minus the strike price. So here the spot price is 5,000. Okay, this is 5,000. And the strike price, let's suppose I'm taking is 4,900. So I'm buying cheaper. So that comes to how much? 100 rupee is my intrinsic value. Then what is this extra 130? Why it is 130? This 30 rupees extra is your time value. Okay, so time value of money is basically the opportunity cost of keeping the contract with you. So time value of money you can say is premium minus intrinsic value. So here in this case the premium is 130 and intrinsic value is 100. So 30 rupees is your time value. So I can say that premium equals to the intrinsic value plus time value of money. So this total is premium. So this 130 includes a 100 rupees intrinsic value and time value of 30. So why we have 30 rupees time value? Because there is time remaining till expiry. Let's suppose we are on the date of expiry. Then there will be no time value on any of the contract. It will be hardly 1 paisa, 10 paisa, 50 paisa, not more than that. Near the time of expiry, let's say 9:30 is the closing of the contract. At that time, almost nothing will have time value, only the intrinsic value. So I can say on the date of expiry, the time value becomes zero for all the out of the money contract. So in out of the money contracts, there is no intrinsic value. So do we have an intrinsic value at the money? No, because the spot is 5,000 and strike is 5,000. So if a spot minus strike is zero, so no intrinsic value. So here this premium is the entire time value of money. If I talk about the out of the money contract 5,100, so the spot is 5,000 and the strike I am taking is 5,100. Now intrinsic value cannot go negative. It can be up to zero. Why? See, tell me one thing. If you have a house, okay, what could be the least possible value? Zero? Will it go negative? So assets value normally does not go negative. So it can be zero. So the remaining 50 rupees or 40 rupees here is the time value. So I can say the premium here is 40 rupees, which is only the time value. There is no intrinsic value and out of the money contract, right? And this out of the money contract, this 40 rupees will become zero on the date of expiry because there will be no days remaining. Here it is 40 because we have 30 days remaining, or let's say 20 days remaining, or any day remaining. We have some intrinsic value. So I can say when you see the premium online, when you're deciding to buy, because this is the premium amount you have to pay to buy a future contract. So this is the premium amount you are paying, so you can realize if it's out of the money, it has only time value. Okay? So remember this thing. Don't forget it. So I'll release all those things. Now, so when we are trading online, when you are buying option contract, let's say I decide to buy a call option. So how much I have to pay? So I have to pay premium into lot size. So let's suppose the Nifty premium for at the money contract is 50. So 50 is the premium. Lot size is 75. Okay, so that means how much you have to pay? 50 into 75. Around how much it will go to? Around 3,750 you have to pay to get one contract, okay, of Nifty. That's it. And if you're planning to buy an out of the money contract 5,300, in that situation I have to pay a premium of 20 into lot size is 25. That means hardly 1,500. Okay, so this is what I have to pay. Now how will I make profit? I make profit only when my break even is achieved and the price is more than that. So what is my break even point? So my strike price was 5,300. Remember from previous example, property 1.1 was strike price and premium both includes becomes the break even, total cost, and premium here is 20. So my break even point will be 5,320. So if the spot price, which is currently 5,000, or the current market price of this index is 5,000, it goes up, it goes up, it goes up, it goes up to 5,000, let's say 350. In that situation, you will make money. How much? So you bought at 5,320. Okay, so 5,300 strike price, market went to 5,350. So the difference here is 30 rupees, which you are making profit. Okay, and if the price is below the market, let's say 5,300, let's say price goes to 5,100. Let's say price remains still 5,100. In that situation, you bought at how much? 5,300, and market is below 5,300. It is up to only 5,100. Price increased. You bought at a higher price on first day. You can buy, you can have a deal at any price you want to have a deal. You assume that the market will go to 5,500, but it didn't go. It went up to only 5,100. Price increase only 100 points. In that situation, it is not hitting your buying price. So you actually procured the underlying asset at a higher price. You calculated, wrong. It was a miscalculation. Your assumptions or speculation was wrong. The market only went to 5,100. In that situation, you bought the asset at a higher price. At what price? 5,320. So what will be your loss? Your loss will not be 220. Your loss will be only 20 rupees, the premium you paid, because you will deny, you will not execute the option contract. You will simply leave the option contract as it is on the exchange. You lapse it. You don't go to exchange, you don't do anything on the trading terminal. It will be automatically closed, and you will book a loss of 20 rupees per contract, and you have a 75 lot size, so 1,500 loss you will incur, not more than that. And if the price goes higher, let's say 30 rupees, in that situation you have a profit of 30 into 75. That goes to how much? 2,150. So that means around a profit of 650, I guess. Sorry, a profit of 750. A profit of 750 on an investment of 1,500, which means around 50% return on the investment. That is huge. Anyways, so this is what happens when you buy and sell an option contract. We will take some live examples, then you will have better understanding of the contract. Okay, so what we will do is, in upcoming class we will discuss how do we do the live trading into this thing. We'll take some live examples, okay, and from the live softwares, and we will take how do we do this thing, and we will teach you how to calculate the profit and loss, and that will be more interactive. Till then, what we do is take care, okay, and we'll see you tomorrow around, let's say, same time, and we'll take the classes further from ahead. So till then, take care. Bye bye.